ASML just crushed earnings with 8.8 billion euros in revenue, then dropped nearly 5%. Morgan Stanley posted record revenue of $20.6 billion, and Bank of America beat estimates for the 24th quarter in a row. Today, we break down the three biggest earnings winners of the day and whether the market is getting it right. Welcome to the Money Mind. Today, we are doing a deep dive into ASML, Morgan Stanley, and Bank of America, breaking down earnings, guidance, and what it means for your portfolio. Let us get into it. Let us start with ASML, the Dutch company that literally makes the machines that make the world's most advanced chips. If you own a smartphone, use AI, or drive a modern car, ASML's technology is somewhere in that supply chain. They are the only company on Earth that can build extreme ultraviolet lithography machines, the kind that TSMC, Samsung, and Intel need to make cutting-edge processors. Think of them as the arms dealer of the semiconductor industry. Without ASML, the AI revolution does not happen. Now here's where it gets interesting. ASML reported Q1 2026 revenue of 8.8 billion euros. That is roughly $10.4 billion, beating estimates of 8.5 billion. Net income came in at 2.8 billion euros, above expectations of 2.5 billion. Earnings per share landed at 7.15 euros versus the 6-year consensus, a massive 19% beat. Gross margins hit 53%, right at the top of their guidance range, and they raised their full-year outlook to 36 to 40 billion euros, up from the previous 34 to 39 billion range. Their backlog sits at a staggering 38.8 billion euros, with EUV capacity booked through 2027. Orders are literally extending 2 years out because demand for AI chips is that intense. So why did the stock drop nearly 5% after all of this? 2 words: China restrictions. System sales to China fell to 19% of overall sales in Q1, down from 36% just 1 quarter ago. New legislation moving through Congress could ban even ASML's less advanced machines from being exported to China. JP Morgan estimates this could cut ASML's earnings by up to 10%. The stock trades around $830 with a 52-week range of roughly 549 to 1,313 in euro terms. Analyst consensus sits around 420 euros with a high target of 1,700. The bull case is simple. AI spending is accelerating, and ASML has zero competition. The bear case: geopolitics could seriously dent revenue. Bank of America just reiterated their buy rating with a 598 euro target. Next up, Morgan Stanley. If ASML is the backbone of semiconductors, Morgan Stanley is the backbone of Wall Street deal-making. They run one of the largest wealth management platforms in the world, and their institutional securities division is a trading powerhouse. When markets are active and deals are flowing, Morgan Stanley prints money. And that is exactly what happened this quarter. Morgan Stanley reported Q1 2026 revenue of $20.6 billion, an all-time record, up 16% from a year ago and beating estimates of 19.7 billion. Earnings per share came in at 3.43 versus the 3.02 consensus, a 13.6% beat. Net income hit $5.6 billion, and they delivered a return on tangible equity of 27.1%, which is elite for a bank this size. Their institutional securities division generated record revenue of $10.7 billion, with investment banking revenues surging 36%. Wealth management also set a record at $8.5 billion in revenue, pulling in $118.4 billion of net new assets. The firm returned $1.75 billion to shareholders through buybacks and declared a $1 per share quarterly dividend. Morgan Stanley trades around $192, near its 52-week high of about $195. The trailing PE ratio is 16.25 with a forward PE of 14.60, reasonable for a company growing this fast. Market cap is around $305 billion. Analyst consensus is buy with an average target of $190 and a high of 221. The bull case: Deal-making activity keeps accelerating with a healthy IPO pipeline and M&A recovery. The bear case is that trading revenue can be volatile, and if the Middle East situation escalates, market activity could slow down. But right now, Morgan Stanley is firing on all cylinders. Finally, let us talk Bank of America, the largest consumer bank in the U.S. by deposits. While Morgan Stanley focuses on Wall Street, Bank of America is Main Street. They serve over 69 million consumers and small businesses, and they benefit directly from the health of the American economy. Bank of America reported Q1 2026 earnings per share of $1.11 versus the 1.01 estimate, a 10% beat, and their 24th consecutive quarter of beating expectations. That is 6 straight years of earnings surprises. Revenue rose 7% to $30.3 billion, topping the $29.9 billion estimate. Net income hit $8.6 billion, up 17% year over year. Net interest income, the bread and butter for any traditional bank, grew 9% to $15.7 billion as higher balances and asset repricing kicked in. Operating leverage came in at 2.9%, meaning expenses grew slower than revenue. They returned over $9 billion to shareholders through dividends and buybacks. Think of Bank of America like a freight train. It is not flashy, but it is incredibly hard to stop once it gets momentum. Bank of America trades around $49 with a PE ratio of 12.26, trailing and 10.78 forward, making it the cheapest of our 3 picks by a wide margin. Market cap is about $335 billion. Analyst consensus is overwhelmingly positive, 85% rated a buy or strong buy with an average target around $59, implying nearly 20% upside. The bull case, rising interest income, disciplined cost management, and a strong consumer. The bear case, if we hit a recession, loan losses could spike and net interest income could compress. But for now, the numbers speak for themselves. So which of these 3 earnings winners looks strongest? ASML is the technology monopoly with a massive backlog and AI tailwinds, but geopolitical risk is real, and the valuation is premium. Morgan Stanley is the deal-making machine, hitting record after record, but at a 52-week high, the easy money might already be made. Bank of America is the value play, cheapest PE, most consistent earnings beats, and the most upside to analyst targets. If I had to rank them, I would say Bank of America offers the best risk-reward right now. Morgan Stanley is the momentum play, and ASML is the long-term compounder you buy on dips. And this China sell-off might be one of those dips. But remember, this is not financial advice. Always do your own research before putting money to work. If you found this helpful, hit subscribe and check out our other videos. I am the Money Mind. Let us keep building.